But so eventually I'm going to rebrand this and call it something else. I think Multifamily Mastery is the name that's going to stick. But welcome everybody. Thanks for coming. This is a once a month thing that we do. It's an opportunity to meet other people and to hear from an expert in the field. And tonight we have Drew Whitson on the line with us. He's let me see if I can remember his bio. First of all, he's a coach in the Michael Blanc Network. He's also a professor of finance. Is that right? Finance, right? At Bethel University in St. Paul, Minnesota. And if you guys, showed up early enough, you'll know that in Bethel or St. Paul, Minnesota right now where he's at, it's about 3 or 4 degrees below zero. Is that what you said it is right now?
Correct.
Yeah.
And it's going to drop to negative 25 degrees.
Yeah. No big deal. Negative 20. I mean, once you're below zero, it doesn't really matter, Yeah. Incidentally, I think the only thing that really matters once you get that cold is how long does it take you to die, So, anyway, so got Drew on the line with us, and Drew, welcome. Thank you very much for coming on with us today.
Yeah. Oh, anything for you guys, man. I've known you guys a long time, and I saw you before you even started doing deals. So it's super exciting to be able to chat with you and hear all the stuff that you guys are doing with the Four Oaks. And so it's just been a great, anything for you guys. Happy to do it.
Yeah. And incidentally, just the history, when I threw my towel in with this multifamily thing, the first event I ever went to was a multifamily conference that Michael Blanc flew. It was here in the DC area. Reston, Virginia. And one of the first people I met was actually Drew Whitson. So, and I still remember, I remember it was you and Drew Niffen, talking shop, basically you had a little crowd around you, and I just decided to walk over and see what was going on. But, little did I know at the time. So, and I was literally there just to check things out and see if it was, I don't know, part of it for me was, it was vetting the whole Michael Blanc program. And, for those, those who don't know me, I ended up going forward with Michael Blanc coaching. Drew, I told you this before, but I actually requested you by name, and they said that you were full at the time. But anyway, so yeah, for everyone here, we do have a little history. I think Drew's been a mentor of mine. He was a mentor of one of my partners. Todd Butler was one of his mentoring students, also in the Michael Blanc program. And so Drew's been very influential in, Four Oaks Capital trajectory from here. So that's it. Drew, do you want to go ahead and introduce yourself and tell us, a little bit about your background?
Yeah. So my name is Drew Whitson. I'm up in St. Paul, freezing up here. We had a pretty great little event. I don't know if you've ever done this before, but when it's as cold as it is in Minnesota, one of the fun things you can do is take a pot of boiling water. And if you go outside and you throw this boiling water in the air, the whole thing just dissipates into steam. It's kind of amazing if you can Google that. So it's kind of a little fun thing I like to show off to people who aren't sort of in the area. But I teach at Bethel University. I'm a professor of finance. I ended up teaching there after I left my corporate job. And I was able to leave my corporate job because many years ago, I started investing in real estate. I started out doing single family homes. And back during the housing crisis, 2009, 2010, 2011. And I didn't know much about real estate back then. I did know that as I was buying these single family homes, the rent was going up on them as the price was going down. And so I just kind of kept buying it. I didn't know much about real estate, but I knew finance, and it seemed like magic to me. So I ended up, being able to acquire a group of single family homes. And then as those appreciated, I was able to work with some corporate, some commercial lending, and acquire some additional higher leverage commercial loans on those properties, and used some of that original equity stripping in order to get into some multifamily properties in the greater Twin Cities area. I started out just doing joint venture deals. I had one or two buddies around in the Twin Cities, and we bought a 3-plex, and then we bought a 4-plex, and really sort of saw the value in getting multifamily assets that had professional property management. And then pretty soon we were moved on to a 32 unit. And I think that's kind of when the lights turned on for me, was when we got this 32 unit. And frankly, getting that 32 unit was easier than buying a single family home. It was easier than going through any of the, retail lending outlets like Wells Fargo or US Bank. And so by going with a small commercial lender, we could acquire, instantly acquire 32 units. And that's when the light bulb moment for me is that you can scale up with larger assets using commercial lending partners. One roof, one boiler. It was just really an efficient way to grow your business. And even easier was my lending partners were much more like my business partners. When you try to get a loan from Wells Fargo, it's sort of you versus them, right? They're checking you out, you're checking them out, competing for rates. But with a small commercial local lender, it felt like we were building a business together. They were able to attend showings and sort of really advocated for us with a sort of a very small lending committee. And then after that, we kept doing more joint venture deals with other people in town here. But eventually we got to the point where we found more deals than we had money. And so that's kind of what ended up leading us down the path of syndication. Was we needed a legal structure that allowed us to take in investor dollars and do that in a legal way that represents the type of risks that we're bringing them on board. Because if they're not partnering with you, they're your investors. And we needed an appropriate way to make sure that we were protecting ourselves and protecting them. And from there, we started doing syndications here in the Twin Cities. I then expanded into the Memphis market and have continued to expand along in the Mid-South area. So Memphis, Little Rock, Huntsville. I got a few other smaller deals, like with Four Oaks. I actually partnered with them on a deal out in Carolina.
Yeah, Spartanburg.
Spartanburg.
Yep.
A couple deals at Oklahoma City. So all in, I was able to build up a portfolio and was able to leave my corporate job. I spent years working at Target Corporation as in corporate finance. Left my corporate job just to focus on real estate, but realized pretty quickly into it that I'm an investor of real estate. I do not have a job in real estate, and those are pretty distinctive things. And so, with my free time, I decided to go back to my alma mater, which is Bethel University, and they had a tenure track finance professor position open up that I'm on my third year right now teaching with them. Nice. So it's been a great transition. I've been able to use some of my real estate and private equity experience and bring that into the classroom for my students. And it's kind of a fun thing in the space. I don't think anyone else is sort of a professor of real estate out there. So I kind of have a little bit of a niche on the real estate side as well. So as of today, I'm a managing member in about 3,000 units here in the Twin Cities and through the Mid-South. And I'm working on more. And I'm able to build this business I was able to build it while working a full-time corporate job, and I'm able to continue building it while pursuing an academic position.
Yeah, nice. So started out single family. Just to recap, we had a couple people log on late, but started out single family, and you went into small multifamily after proving the concept works with single family.
Yep.
And then made the jump from 4 or 5 unit properties to a 30 something, and then never looked back, essentially.
Yep, correct.
All right.
Yep.
And as far as your job with Bethel, that's because you like the job and you want to do it, not because you need the job, right?
Yeah, absolutely. Yeah, 100%. I was, when you have the ability to be financially free and choose whatever you want, people gravitate not simply towards, I want to sip margaritas on the beach and, spend my days in a hammock, relaxing. I think that there is an attractiveness to that initially, but at every point, someone decides that they want to do something more meaningful with their life, and you gravitate towards things that have probably impacted you. And that's where I sort of found my interest was. A lot of the people who had invested in me earlier that allowed me to be successful later on in life came from that experience. So it's my goal to go back and teach there. So yeah, my 22-year-old undergraduate students, actually, some of them make more than me when they graduate, because they've got some great degrees and they're really, really smart. And so, yeah, I feel that my time there is an act of service. And so that's an exciting thing for me to be able to continue to engage in a meaningful way in the world. That provides hopeful value, right? I always tell my students, I say, I hope that the people who've invested in you during your 4 years at an undergraduate school will allow you to go out and be successful. So in 20 years, you come back and can take my spot. So that's always my hope, is that those students will come back and take over for me someday.
Yeah, that's something that resonates with me. I've always enjoyed teaching, and if you kind of look at the job that I would gravitate towards, if money didn't matter, I actually wanted to be a math professor at one point in time at the
Yeah.
University of Utah, which was my alma mater. But
Yep.
we'll see if that ever happens again. At this point, I don't think it's in the cards anymore. But now, I think one time we talked, you also mentioned that you'll actually bring some of your deals into the classroom, right?
I do. Yeah. One of the classes I teach is called Financial Modeling and Valuations. And every semester I take my class through through a deal that I'm working on. And so basically every semester I always have something going on. I might be early or late, but I try to pair it up well with the class. And really what it does is it kind of just lets them look under the hood of what private equity looks like. There is a lot of private equity deals that happen in the United States, but most of them are pretty private, right? You don't hear about them in the news. You don't hear about them in the Wall Street Journal. There's just not a lot of visibility to how those work. So for me, this is a chance to sort of take them through, hey, here's how I found this property. Here's how it was underwritten, how we underwrote it. Here's how it was negotiated in finance. So I get a chance to help them talk through how we do the valuation of the assets, how we do the financing, how we work with investors, how we structure deals and incentives, and how we get the deals closed. And so that sort of that's 15 to 16 week semester is just about that perfect time to kind of walk through them, kind of what this looks like. So every once a week, I have a little kind of time carved out in my class to say, hey, let's give you a quick update on what I've been working on and what has progressed. The timing doesn't always work out. Usually the deal is a little bit further ahead than I am in the classroom. But it kind of just helps them unlock it a little bit and gets their mind thinking a little bit differently about what financial entrepreneurship looks like. That there's a lot of ways to make money out there. Not all of it requires going to get a W-2 job. And I always encourage them to do that. I think that's a great experience. Gives them some professional development, gives them some credibility, some hard skills. But I do want to plant that seed of entrepreneurship and independence. And the fact that most of the wealthiest people in the world aren't the CEOs of Fortune 50 companies. Like they make money, but the real money, that's made in private equity and business owners. That's where real wealth is created.
Yeah, true. So that's very interesting. I mean, I'm never was a finance major. I don't think I took a single class from business going through my career, but I was recently asked to be on a panel on a presentation at a major university to a bunch of finance graduate students. And I was literally scratching my head thinking, I've got 2 degrees in math and 1 in international relations. What can I teach to graduate finance students? But I think you gave me the answer right there. And the answer is they haven't seen private equity before. So
yes.
Introduce them to the world of private equity.
Yeah.
So going back to your story a little bit, you said you went from single family houses to 3-plex to 4-plex. Going back, if you were to go back knowing then what you knew now, what would your trajectory have looked like?
I probably would have skipped over the single family homes. I think I would have. I think my perception, Brian, was that multifamily assets have such a high dollar amount that individuals don't have an ability to access that.
Right.
I always thought that if something was trading more than $1 million, the market simply was so efficient that I could not compete against professional buyers. Right. That was my mentality. And it turns out that wasn't true. Right. I have met the biggest yo-yos you've ever met in this business. Just a bunch of soup for brains people who have made money in this business and have done it well because they've been patient, they've got in and they've leveraged appropriately. But man, I'm telling you, if some of these people that I've met, that I bought buildings from, who've been made multimillionaires, and if they can do it, anyone can. And so I really think about that gap in my expectations, that simply I wasn't smart enough and couldn't compete. And couldn't bring enough capital, right? The idea that you can bring that syndication allows you to aggregate investors in a legal way and with enough incentive for me as the person that was finding these deals. I think that really would have jump-started my real estate career, is figuring out how to build a business in my 20s, not in my 30s. I think that would have been really valuable for me.
Yeah. It would have definitely helped out, And I look back at my trajectory, and I was fortunate enough to find podcasts about multifamily and to be able to find events and get around other people who did it. And the same event where we met, a couple of people had an amazing influence on me just by little things they said. Hey, you don't need to look for that six unit, that 8 unit, that 12 unit. You can go right into the syndication mode. So Looking around the room at the people that I know, I'm going to do a real quick pop quiz. I should have started with this, but everybody get your chat ready, and we're going to just ask everybody to put a single number in the chat box. Okay. Put the number 0 in if you have not been a GP or you do not own any multifamily assets, and a 1 if you are a multifamily owner, if you've been a GP on a multifamily property. LP doesn't count. Okay. Susie, did you guys close? I don't hear her. Susie, can you hear me?
Yeah, I was still typing in chat.
Okay.
I said 4 days away, but I was still counting it.
Okay. Good.
Yeah.
Well, I'll give you congratulations now, and then again 4 days from now. All right. So yeah, looking over, we have a handful of 1s and mostly 0s. Yes, HEMA LP does count for something, absolutely. But okay. So given the group that we have with mostly 0s, let's keep the level a little more baseline. So let's start work. Let's talk about starting out. When you make the decision to go all into multifamily, what do you think are some of the most important steps to take as an aspiring investor?
So when you say go into multifamily, you mean like full time? You quit your day job and just do this full time, or do you mean like just starting to get into the business?
Starting to get into the business. So you're looking for your first multifamily asset. You've decided you want to do multifamily for whatever reason. You know, if the end game is getting out of your job or just creating more cash flow. All right, you've decided that you want to chase that first multifamily deal.
Yep. My advice is ask yourself the question, what is the advantage that you have that no one else has? Right. One of the things I mentioned earlier is that I thought the market was really efficient. And here's why: this market will never be efficient. There will always be good deals. And the reason is because every 6 blocks in America, every time you move 6 blocks in one direction in America, you're in a little bit of a different market, right? Every 6 blocks, north, south, east, or west, things are a little bit different. Buildings are a different age. Things were developed at different times. The neighborhood has characteristics that it didn't 6 blocks in any other direction. And so when you're looking to try to find that first deal, I always tell people, what market knowledge, what information do you have that no one else does, right? And that would be primarily based upon your geographic boundaries, right? What is the neighborhood that you live in? What are the neighborhoods that you have families in? What are areas you went to school? What are the areas that you have friends or relatives or associates or have been in contact with work, right? Start with what you know, because you have every advantage in those markets. People often tell me, well, I want to go to a different market. I want to start in a new market, right? And I'm telling you right now, there's no magic market. There's no magic market that has deals plentiful and lenders lined up and great property managers. Every market has competition. And so start with where you're currently at, what advantages you have. And that's the advantage you're going to start with, right? I tell people when I first bought my single family homes, I didn't know anything about real estate, but I knew my neighborhood. I knew everything was built in 1954 to 1955, had 3 bedrooms, 1 bathroom, hardwood floors under the carpet. And I only bought houses that I could hit with a 5-iron, and I was a terrible golfer, right? I just did not buy things very far from my house. Right? My first couple acquisitions, I could see from my backyard, and I was comfortable with. So start with what you know immediately, and then work your way out, right? Start with the advantages you have and what you know to be true about what's happening in what parts of markets. That's where you're going to find the kinds of, you're going to be able to have the best kinds of conversations with brokers because you have intimate knowledge of that market. You can have good conversations with lenders because you can have a great ability to communicate that you have appropriately assessed the risk of those investments. You know what the trends on the rent or the costs and the prices are because you've been part of those. And so it gives you every advantage, even talking to your investors, right? You're telling them about a property that you have an intimate knowledge on, not because you just found it online and researched it, because you happen to know about it because it sits within your backyard of where you live or where you work. And so you have more advantages in this market, even if you haven't done a deal, than you probably realize.
Yeah, I like that. I like that. So here's another question. There are still people who invest out of state or out of their own markets. What do you think is at what point do you think somebody should decide to look outside of their market? I mean, once you've looked inside your market, is there any magic number or any metric that you can point to that says maybe you should look somewhere else?
Yeah. Yes, I think there is. Some of it has to do with what sort of propensity your investors have for risk and return. One of the reasons that drove me outside of the Twin Cities is that cap rates on like C-class 100-year-old assets are trading at or below 5. It's impossible to make money. I cannot hit the kind of returns that I need in order to attract the investors, in order to grow my business, which is why I went into Memphis. And so that was one of my expansion years, that the Twin Cities market was too good, right? It was too hot to allow me to hit the kind of return requirements that I need. So that was part of it. I think that if you're in a market that is simply, if you're in Lower Manhattan, if you're in San Francisco Bay, Minneapolis was one of the top multifamily cities for years, and prices and cap rates simply compressed. And it was hard to make that. So I wanted more risk. I wanted more return. And I think that's what drove me away from my local market. But I'm still doing deals. I just closed 400 units in the last 6 weeks here in the Twin Cities. So I'm still doing deals, but I don't have the ability to expand. And I don't always lead with markets. I lead with partners. So when I'm exploring the market, I don't want to just know about the market. I don't care if the market's as good or not, is if I can find excellent partners, primarily property management firms that have an ability to execute a plan, have a density in the market, and can really act as a business partner through my acquisitions process. In fact, when I get a new deal that lands in my inbox, I don't underwrite it. I don't look it up. I send it to my property manager and I say, what do you think about this? Right? Because they can give me very specific market information that I could spend hours and hours and not being able to glean. So market expansion really should be timed with investor propensity for risk and returns. It should be paired with a great partner network that will allow you to be successful. And third, and I don't want to underestimate this, is it has to be a market that is deeply accessible to where you live. Memphis, I'm in Minneapolis, St. Paul. I can fly to Memphis in 90 minutes. So I can have breakfast with my kids. I can go to Memphis and be on the ground for 5 hours to do a property tour, meet with someone for lunch, right? Connect and look at another property, and I'm home for dinner. Right. It is an accessible market. It is people who live in Seattle who invest in like Miami or some sort of tertiary market that you have to fly back. You're making 3 connections together. It's an all-day activity. So having accessibility to that market is a incredibly important requirement. And I always say, look, if you can't drive or fly there within 2 hours, pick a different market. You probably need to find something that is more accessible for you.
Yeah, and that was part of my initial metric. When I started looking at markets, I moved from San Diego to DC, which are probably 2 of the toughest markets to get into. And so I drew a circle and I said, where can I get to by noon? If I wake up early, get in my car, how long of a circle on the map. Took me all the way down to South Carolina. And same thing for me. I can wake up early, get anywhere in South Carolina by noon, or do exactly what you did. It's about a 70-minute flight from here to Columbia if I get direct. But I like that. I like that. So you talk a lot about your investors. Let's say you're so new to this that you have no investors.
Yeah.
How do we start that train rolling?
Yeah. So there's a couple ways to do that, right? My first investors were my people that were in my immediate circle of contacts, right? It was my parents. It was my cousin. It was, my neighbor, right? It was people who had specifically seen the work that I was doing. I didn't have to shop for investors, right? These were people that were in my immediate relationship circle. And a lot of people are really nervous about taking money from family and friends, right? They'd rather take it from a stranger because it's less scary. I understand that, but it should be the opposite. You should be terrified because you're going to mess up Thanksgiving for the next 10 years if you lose your brother's money, right? So I would say taking money from family and friends should be less scary than your neighbors because they're your family, right? And because you don't know someone doesn't mean that they're any less has any less desire to lose their money. So I say start with where you're at, right? I remember my first couple of deals, Brian, man, I cashed out retirement accounts. I took out credit card loans. I think my first single family home, I borrowed money from my grandma. Like I was searching for capital anywhere. Until I sort of was able to build up a little bit of a personal balance sheet that allowed me to, when I invest in deals or syndicate deals, I put money with my investors, right? So it's not, hey, I want to sell you on this great investment. It's, hey, I'm going to put my own money into this deal. And I think this could be a great opportunity for you if you're interested. And here's some of the success I've had. And here's why I think it's a great opportunity. So I think there's an easier way to sell that isn't quite as scary. Mm-hmm. And yeah, I think raising capital just starts at home. You can use your own retirement accounts. You should use if you're not comfortable putting your friend and family's money into it, maybe it's not as good of a deal, right? That's, there's the mother-in-law rule, right? If you want to put your mother-in-law into it, or that's my social media rule, by the way. If I'm not willing to read out loud exactly what I put into any of my social media accounts to my mother-in-law, then I shouldn't write it down. That's my filtering device, is saying things to my mother-in-law I wouldn't want to be embarrassed about.
The mother-in-law rule. I like that one. Good. So you talk to your friends and family first, and I think that's a good idea. Let's go next steps. Let's say you've done a deal or two and you've exhausted your local network, friends and family.
Yep.
What are the next steps?
Yeah. I had one of the next steps, and I'm going to look at this. One of the Kenneth asked the question, what if you know your local market is not good? Here's why, and this answers the same question. Here's why continuing to look in your local market is going to be, you want to continue to do it, is because that is where you are going to find your investors. That is the most likely chance that you will ever have to get investors, is to meet someone face to face. I don't think I've maybe had one investor I've never met face to face. Because unless you're like a Brian Briscoe and you got all the time in the world to do social media and build a platform and build a brand and build a podcast and newsletters and all these things, right? It's really hard to build an online investor base. People want to invest in deals because they believe in you. They trust what you're doing, and they understand that they don't want to understand that the deal is good. They want to understand that you understand that the deal is good. They want to know that you have a level of competence and a level of you can appropriately articulate both the risks and the opportunities within the deal. They're investing in you, and that is really hard to do over email or even on Zoom, right? You need to meet people face to face. So that's like step 2, right? Is start to network with people in your own home market that you can sit down and have coffee with and say, is there partnership opportunities? Is there investment opportunities? And just meet people face to face. I can't stress this enough, right? Zoom doesn't cut it. Meet them face to face. There's a natural back and forth and engagement and trust that happens when you look someone directly into the eye, not through the camera, right? But you can look them directly in the eye, and they will get a sense of authenticity, and authenticity is what people invest in. If you see people like Michael Blanc and Grant Cardone, right? In their hot tub, in their jet, drinking some, like talking about real estate, like you're never going to out Grant Cardone, right? You're never going to do podcasts better than Michael Blanc, who's just like, hey, everyone, whoa, we're doing apartments, right? You're never going to be able to outdo that. And so what you need to do is create an authentic brand that fits who you are, which is why I don't even have a website. Like I literally don't have a website. I don't do Facebook. I don't have a podcast, right? I have a list of, 36 investors on an Excel spreadsheet, and I just get to do this. And I've raised tens of millions of dollars that way without doing anything, but I've done it in a way that is authentic to who I am. And then I can look face to face. So find it, meet people locally. You can network online is a great thing, right? You can still find people to online. Go to meetup groups. And here's the thing, meetup groups are dying for speakers, right? If you learn just a little bit about multifamily, put together a little 10-minute presentation to kick things off. Here's the 5 bullet points of what I think are great reasons to invest in apartments. People will set up coffee with you in your stall to build your network, right? So finding people locally is really going to be sort of step 2. And maybe step 3 is sort of getting more, that's more complex. But I think step 2, everyone's got money. I mean, everyone has access to money if you just know where to ask and where to look.
Yeah, I love that. Yeah, and something interesting. I think a lot of people when they're starting out, they put a lot of emphasis in, well, I need my website, I need my domain, I need my, the business cards, I need X and Y and Z. And I want you to go back and say that again. Do you have a website?
I don't have a website. Whitson Capital does not exist. You can go buy it right now and then charge me $1 million in 10 years when I decide I want to buy it, right? It's not out there. I don't have a website. I don't do Facebook. I don't do any of that, right? I don't do any of that.
Yeah. So at the end of the day, there's lots of different ways to raise capital. And one thing that I really like about what you do, Drew, is it is authentic. You have a very small group of investors. And actually, how about this question? What percentage of your investors are in the Twin Cities metro area?
Oh, I bet either I know them from the Twin Cities. I mean, it starts with a 9. It's 90% something. Mm-hmm. Yeah, maybe mid 90s in terms of dollars raised. Yeah.
Okay. So you've raised tens of millions of dollars from, what really is not a large number of investors, and you've done it all from exactly what you're saying, telling everybody else to do, going out and meeting people over lunch or over coffee or whatever.
Yep.
Okay. I think that is very, very powerful. And, there's I think a couple of different, most people, and, not criticizing Michael Blanc. I mean, he's also raised tens of millions of dollars. He teaches people how to build a platform, and his platform, his what he does works.
Yep.
What I'm pointing out is it's not the only way to do it.
Yep.
Okay. So.
Yeah. And here's the other thing about that, Brian, is that the private equity space is highly disproportionately represented by people who do platforms, right? If you took everyone that does platform building, right? You took Rod Khleif and Michael Blanc and Grant Cardone and Mark Ken, you took all those guys combined, right? You just think they're these behemoths in the private equity world in the multifamily space. They're probably a low single digits of what actually occurs in this country, right? In terms of multifamily private equity syndications, they make 95% of the noise, but probably command low single digits in terms of actual dollar transactions that happen in the country. So there is a high amount of disproportionate representation by those who make the noise and those who do the deals. Even looking at the multifamily, even looking at the mentors, right? The coaches for Michael Blanc, of the 6 of us or 7 of us, I mean, there's probably been 10 in the last 3 years, and one of those 10 has built a platform, Todd Dexheimer, with Pillars of Wealth Creation, episode 184. It's really good. Yes. But aside from that one, right? Aside from that one, everyone else, 9 out of the other 10, we built businesses like I did. And maybe some of them have websites, but it's all very private equity driven. And so don't be scared to do that. But here's the thing. If you're a platform guy, and I recognize some names, some people in here, like if you're a platform guy, be the platform guy. Like you don't have to do what is authentic to you, the brand that you've built and the strategy that you have. That's great, because some people do that really, really well and have been very successful doing that. Obviously, Four Oaks, you guys have done a great job. You've been able to get a big investor base and raise capital and do that. And you've got a very clear brand, and but you're authentic to who you guys are. I think you guys started with that and then worked outward. You didn't say, let's do this and who's going to fit into it. You said, okay, who's going to fit into this? And now what works with the personalities and types and skill sets? And then you built that outward.
Yeah. And we had our 4th deal, just hit our 4th deal when we really started thinking about platforms, but, and interesting, I'm just comparing notes. I mean, Four Oaks, we just hit our $10 million raise amount. And I was just looking at the numbers earlier today. We had 120 different people coming in. And I'll tell you what, I would rather be Drew Whitson with a spreadsheet of 36 people than, us with our spreadsheet of 120, just because there's a lot more power into that. Especially if you have the right 36 people on board with you.
Right.
All right. So we talked a lot about raising money. Now let's I think the big 3 things in my mind, and, if you can think of something else, finding deals, finding money, and then building the team. Those I think are the 3 things that this business relies on. You talked a little bit about property managers and the team. Mm-hmm. We talked a lot about money. Let's focus a little bit on finding deals.
Yeah. I'll tell you a quick story here. So I have about 1,300 units in the Memphis market, and of those, that comprise 5 transactions. So I've got 5 transactions, which gives me 1,300 units in the Memphis market. For those 5 transactions, I was the backup offer on those deals. And so one of the things that I think is incredibly important is developing that credibility with the listing agent. Because in the Memphis market, probably 90% of all dollars that trade hands in the multifamily space and like the sub $30 million and under are done by like 4 or 5 guys, right? It is a small group of people that represent most of the multifamily. Now, there's other brokers that do other things and other price points, but in my space, $30 million and under in the multifamily, there's like 5 guys that control everything, right? And so my job has always been to cultivate good relationships with them. And I've been able to develop a reputation that I'm the guy that closes when your main guy falls through, right? I said, look, I will never pay your top dollar. If you're going to do a multi-run bidding, I'm never going to chase this up, right? But I'm the guy who will close this. And that's what happens is the primary buyers usually back out because they chase it to the top. They come back and say, all right, Drew, we don't want to take this back to market. What can you do for us? I give them a price, and we've closed 4 out of those 5 deals by being the backup offer, right? And because one of the things that I do is if I lose the deal, they don't accept me, I follow up with that broker every 2 weeks to see how the deal is tracking, letting them know I'm still interested in the market, asking if they have other similar properties in the area that still fit my criteria. So I stay on their radar. I don't just sort of disappear and go pout. I try to say, look, this is someone who has access to a deal, and I want to be that guy when they think, when the deal falls through, and I think more deals probably fall through than actually close, I want them to know that Drew's been bugging them and asking them and is ready to roll. I also spend time to make sure I meet them in person, right? I fly to Memphis, I go shake hands, I look them in the eye, I talk about what we're doing and who our partners are. And that will separate you from a lot of the other sort of tire kickers in that market. I make sure I return their emails and phone calls promptly, even if it's a listing that I have no interest in. Hey, Steve, thank you so much for this listing. I appreciate you keeping me in mind. I'm looking for something a little bit different, a different part of town, a different part of area, different size, type, age, condition, strategy, right? Whatever it is, I reinforce that, hey, I got their email. They get a little flag in their brain that Drew emailed them back. I remind them of what I'm looking for, right? And then we talk about when next time I'm coming into town. And so I've been able to cultivate those relationships and be the backup guy. And so that's kind of how those deals are found. I've never been successful going directly to owners. My goal is never to go around brokers. And most larger deals it's really hard to get direct to owner, anything above maybe $2 million or something. And then, so that was kind of doing the broker side on the deal side. Oh, and the 5th deal that I did in Memphis was a deal that I 100% lost. I just lost the deal. And I'd been to Memphis and I'd seen this property and I lost the deal. They wouldn't tell me who it was. So I just started texting people until I figured out who it was, who got the deal instead of me. And I called them up and I said, hey, look, I know you just got this deal. I just lost it, but look, I got the money lined up. Let's partner on this. And so by the end of that day, I had worked out a deal with my investor. I had worked out a deal with the other syndication group and sort of got myself inserted into this. And of the 4 GPs, I have the largest ownership, even though I lost the deal. I said, look, I have a solution to someone and I'm going to figure out who it is. And we're going to get this deal done together. And so I just went after it and found the right people and put it together. So that was the 5th deal. I wasn't even the backup guy. I totally lost the deal, but was able to figure out who it was because I knew I could add value to that group immediately. And we had a deal struck within 6 or 7 hours.
Tell you, the thought that came through my mind is that Ricky Bobby, if you're not first, you're last. I mean, that's completely opposite of what's happening here,
Yeah.
So you came in 2nd place, maybe, who knows, maybe you came in 5th place on this one, but
it was definitely 2nd. It was down to me and one other group. Yep.
Okay.
Yep.
So you're 2nd place and you still ended up with a piece of the deal.
Yep.
So just to recap some of the main points, number 1, you try to cultivate the relationship with the brokers.
Yes.
You are very responsive. You are going to be, you're basically, I don't want to call you the squeaky wheel, but the idea is still there. Think of the metaphor, not that he's, sounds squeaky or anything, but you're the squeaky wheel. You're omnipresent. You're like, hey, thanks for that listing. Thanks for this. Thanks for that. And it just keeps on reminding them that you are still out there looking for deals.
Yep.
And you have also demonstrated your ability to close on a deal. So they know that if I need to sell something really quickly, first of all, Drew's emailed me 4 times last week. And so he's going to be the first one to come to mind. And second of all, I know he can close. So boom.
Yeah.
There you go.
Yeah. Yeah.
All right. So let's put, two different concepts together, so we talked about raising the money. We talked about finding the deals. What order should those come in? I mean, do you do a little bit of both? Do you work on both at the same time, or does one take precedence over the other?
The people seem predisposed to want to work on deals before they find the money. I think it's almost the other way around. I think that when you are writing offers on deals, you need to know where that money is coming from, whether it's a specific capital raising partner, whether it's a specific your investor list. Like when I make offers, I don't really have to ask if I can raise $2 million. I know I can raise $2 million, right? So I don't have to be concerned with where that capital is coming from. And I think that gives people, it's easier for people to hunt for deals than it is for people to ask for money. And that's what I have found. We gravitate towards wanting to look for deals. And if you're really not good at raising money, boy, there's tons of people out there that are. And I think there's probably more people that raise money than have access to deals. But I think those need to really either work hand in hand or have your money a little ahead of your deals, because it's hard to raise money from new investors if you're also trying to get them to invest in your deal. Those are 2 separate activities. You want to be able to educate and identify investors that can ask questions and understand what you're doing without having them make a decision. And then when you find a deal, it's really easy, right? Then it's like, oh yeah, hey, remember when we talked about this and you had all these questions and you were excited about this? Well, hey, this is it, right? Here's where you send $100,000,
Mm-hmm.
and they fire it off. So I think money should probably lead a little bit, but you need to work on both of those activities. And let me be clear, raising money and doing deals is not reading more real estate books. It's not listening to more podcasts. It's not working on your newsletters, right? I've actually had coaching students that I've had to fire them from doing all of those things. Cause I'd say, hey, what have you done in the last month? And they said, oh, well, I've listened to these podcasts. I read this book, right? They had all these activities, right? All these sort of things that created noise, but didn't create any momentum. And so I fired them from doing that and say, look, unless you're talking to a property manager, you're talking to a broker or lender, or talking to an investor, you're not moving forward. And then they made a lot more progress toward actually getting deals and getting money. And that was the intention.
Yeah. Yeah. And I actually did the complete opposite. And, sitting where I'm sitting, 3 years later, I wish I would have put the money first, and I think, and then Roberto has a question. I'll touch it a little bit, then I'll pitch it back to you. But his question is about how can a new syndicator show credibility? One thing that I learned is because I did not focus on raising money up front, that it was hard for me to get brokers to take me seriously because they'd ask you 20 questions. I mean, it was almost like playing a game of 20 questions every time you get on the phone with a broker, a brand new broker again, because they are sizing you up.
Yeah.
And if you can't answer the question, where is your capital coming from?
Yep.
Okay. They're not going to talk a lot with you. All right. On the flip side, if you go into that broker call and you've got soft commits for 500, 750,000, that puts you on a whole different level. But, so Drew, I'm going to ask you the same question. It starts out without an online presence. How can a new syndicator show credibility during these in-person meetings?
Yeah. I mean, well, one is I assume the question is it with brokers or with investors? What was the context for this question?
Roberto, that was about the brokers, right? It was about 10 minutes ago. And I think we had just started the broker question, or we're still on the broker question. Roberto, are you still on?
Here's the trick.
It was about the investors, right?
About the investors.
Capital.
Okay.
Yeah.
Well, the investors. Okay.
Investors.
But it probably works for brokers, I guess.
Yeah. Okay. So I'll give you the answer. I give you the trick. Okay. Here's the trick to gaining the confidence of brokers. The trick to gaining confidence of brokers is to be incredibly specific about what you want and what you're looking for, right? If you say, I'm looking for something in the multifamily space, maybe 100 units, right? That is, you think you're casting a wide net, right? You think you're sort of trying to cast a wide net, but what you're communicating to the broker is I'm not really sure what I want, right? My recommendation is be incredibly specific and nuanced, because that will communicate that you understand what you're looking for, you know why you're looking for it, and it helps them target in, even if you don't have to do it that size, but like, how does it sound different when you say, well, I'm looking for something in the multifamily space between 100 and 200 units, maybe some value add, right? Contrast that with, I'm looking for in a multifamily apartment building between these units and price point. I want it built after 1980, but before 2000. I want it to be either a garden style, no elevators. I want it to have a value add component between $100 to $250 with a 10 to 15% renovation. I want it to be how do we say this? Like, start finding all the little nuances of what makes a deal incredibly specific, right? Incredibly specific. And while you might think you're pigeonholing yourself into this tiny matrix of all these qualifications, right? What you're in fact are doing is telling them you really know what you're talking about, right? I really want something in this part of the town with this many units built after 1980 that has some value add, but I want to stay away from, the asphalt. I don't want to stay away from the pitch roofed, properties from the mid 80s, but I really like the stuff from the early 90s with the whatever, right? And the property manager named X, Y, and Z, which you named because they've heard of them, right? Because you know your market, right? Has really informed me that we have some opportunities to work with our investors like X. And so really getting nuanced and specific with the brokers communicates a tremendous amount, and you sound like someone who's going to get them a commission. Mm-hmm. That's the ticket, right? You need to sound like someone who's going to get something closed, what and why you're going to do it and how you're going to do it. So that would be my recommendation for the brokers, is to be specific. I think credibility for investors is really about the opportunity to articulate what and why you want to do it. And we, Brian, you've heard this before, but we often use a sample deal package, right? We provide the syndicator or my coaching student. Now, we don't provide them. They build something that says, look, this isn't the deal I'm going to do, but this is exactly the kind of deal that I intend to do, either by size, geography, strategy, value add component, return calculations, have an appendix with the definitions, right? Whatever it takes, because then you have a chance to really communicate what it is that you're going to do, why you're going to do it, and how you're going to do it, right? That's what develops that trust between the investor and yourself, so that when it comes time for them to write a check, right, they understand that you know what you're talking about, right? You didn't just find something. You're not chasing a Walgreens net lease over here, and then you're chasing self-storage over here, and then you're chasing a multifamily, right? Find a niche, stick with it, right? And stick with it, and get really good at that tiny little niche or whatever that might be.
Yeah, and those sample deal packages, we put a lot of time into our first one, and quite frankly, as soon as we had our first property under contract, from there on out, we used our last pitch deck as, hey, this is what we just closed on. This is what our next deal is going to look like, or here's something we can give you to give you an idea of how we structure things, or what your return profile can be. And it works wonders. I mean, a lot of people will look at it, they'll come back with questions. Same thing with that sample deal package. It's kind of a trial run with no pressure for them to look over what you're doing. Zero pressure, because it's not a real deal.
Right.
So, all right. So a couple other quick questions from the chat room.
Sure.
Let's see. How do you structure your day and week so you can keep touch with the key contacts and follow up with key critical real estate items while supporting your students and family?
Boy, that's great. One of the things that I like about not having a platform is it's a pretty small circle, right? It's a pretty small group of people that everyone on my investor list has probably invested with me before, right? So I take opportunities in my very personalized updates to my investors to sort of talk about what else I'm working on and sort of what's happening in the market. One of the fun things that I get to do when I do my property updates is I also say, hey, look, as someone that sort of intrinsically follows finance and economics, here's some interesting charts I found about that I think provide some insight into what's happening in the financial markets, right? And so I talk about, I in my last email update on Monday, I had this really interesting chart about how 10-year treasuries and junk bond rates how those have changed over time. And I just said, hey, here's what I started seeing in the marketplace in terms of yield and liquidity and the junk bond yields fell below 4%, which was what 10-year treasuries were paying not too long ago, right? Is the frothiness in the equity markets. And so I use those opportunities to communicate expertise and insights that some of them find. I don't think they all read them, but at least give some of them an opportunity to sort of just pick my brain a little bit on what I see is happening in the broader sort of finance and macroeconomic environment. So that's sort of fun. Yeah. Frankly, these are a lot of my friends, right? When you have someone that invests with you over and over again, you just kind of become buddies, right? So it's a very personal relationship. It doesn't take a CRM tool to pop up and say, hey, you need to email Scott and see how, what's going on, right? Because Scott's sort of kind of in my world because we have a good relationship. So
nice. Good one on that. Let's see, pull up chat, see if there's one question about tax advantages. Can you touch on that real quick? And then we'll take any. So how about this? For people listening, we'll do Q&A for another 5 or so minutes. So if you got a question, drop it in, but we'll call it quits in about 5 minutes.
Sure. One of the nice things about being a equity investor is that you get all the benefits of having depreciation. These assets that we are acquiring allow us to write off the values pretty quickly. So if you close on something in the middle of December, you get as much depreciation as if you had owned it the entire year. So as a limited partner, just an investor, you get these big, nice negative K1s that are passive losses that you can pair against other passive gains, or if you have a spouse that has other sort of passive investments, you can pair that against it. So I like to brag. I actually haven't paid any federal income taxes in quite a few years. So, it's when you sort of get to the point where these things are flowing in pretty nicely to offset other gains, it becomes a pretty tax efficient business as well. So, earning $1 in real estate is worth a lot more than earning $1 at a W-2 job, maybe by 50%. So $1 is not $1. It goes differently. It's taxed differently. It's treated differently than other dollars. Investment income is very different than labor income.
Yeah. I'll tell you what, I haven't paid any income tax. There's 1 year that I did not get all of my taxes and more refunded. And that was the year before our third child came along. So I think having 5 kids and investing in real estate together really help out. But
it's awesome.
My oldest 2 are no longer eligible for that child tax credit, but I'm still not going to pay federal taxes this year.
Yes,
so
that's right.
I think this will be 20 out of 21 years in a row where I don't pay federal income tax.
Look at you, man.
I know. And that was just with a couple of single family homes, for most of that time, it was, it's just stringing along single family homes and depreciating them. So
if you've ever wondered why the President Trump never wanted to release his tax returns, it's because he invests like Brian and I do, right? That's his returns look a lot like what ours look like.
Yeah. People get mad when billionaires don't pay federal taxes. It's just one of those things. And anybody who's investing in real estate and doing it wisely, they can come away with a 0 federal tax bill almost every year.
Yep.
You're still paying your payroll taxes, but I mean, that's a drop in the bucket compared to like the 39%, highest tax bracket, but it's actually not 39 anymore. I don't know what it is. All right. So let's see. Oh, hey, we got, I was just going to wrap it up. We got a question from Mauricio. All right. So post-COVID, has the Memphis market only gotten better with high rental rates, good industry makeup of the market, FedEx, et cetera? Okay. So the baseline question is, how has Memphis fared post-COVID?
Yeah. So through the end of January, over the previous 10 months, so since COVID, so March of 2020 to January 2021, Memphis average rent has gone up in the market by 6.7%. It's gone up 6.7%. Now, collections have been a little bit more difficult, but rent has gone up because Memphis is not a tourism industry. It is an industry that is a city that has significantly benefited from a large amount of distribution. It's a distribution hub for the United States. Amazon, Nike, FedEx, man, you have to have half of a heartbeat, and Amazon will pay you $20 to throw packages around in their warehouse, or FedEx will pay you $25 an hour to throw packages on their truck, right? So it's It is a market that is pretty boring. And that's one of the pitches that I have used for my investors is I don't pick Memphis because it's exciting and amazing and sexy and upcoming, right? That is Las Vegas and Nashville and Orlando, right? I tell my investors, when you invest money with me, you're investing in the color beige. You're investing in boring markets to do boring things to make boring returns, right? I do not provide exciting, cool steel and glass development opportunities. I buy ugly stuff that has great risk-adjusted returns in boring markets. And really, our business thesis was proven out in the last year because it was not an economy that was dependent upon high amounts of growth. Right? We can underwrite our deals. I'll give you another example, Brian. The deal I closed in October in Memphis, we for 5 years, the first 5 years of our underwriting, we have zero rent growth. Zero. Like year one rents are identical to year one, not even inflation adjusted, zero. Because we want our deals to stand on their own, regardless of any organic, non-controllable lifts within the marketplace to have it work. And so that's what we sell. We sell boring. We sell uninteresting, and we sell low risk and security. And so that's Memphis, I think, has proved that out over the last year, is that it has had that sustainability that we were hoping for.
Yeah. So you're looking, and this is a quote from one of my partners. I think he says, these things are ATMs. They're not sexy. They're just like ATMs.
Right. Right.
Every quarter you go down and money comes out, so.
Yep.
So simple.
Yep.
All right. Well, hey, Drew, thanks a lot for coming on. And actually, let's do one. If you have one piece of advice for people starting out, and if you could distill, years and years of what you've done down to one simple piece of advice, what would that be?
Yeah, I think it's do a little bit every day. Do a little bit every day. Do something every day, even if it's for 5 or 10 minutes, that leads you towards closer to getting a deal or to getting money, right? Do something, have one phone call, have one email, look at one deal. You're better off spending 10 minutes, 5 days a week than spending 1 hour on Saturday, right? That tiny little bit of daily action will probably lead to 2 or 3 more, right? Moving the ball a little bit every day and do things that lead you to outcomes that you want, right? I love books and I love podcasts, but those don't lead to outcomes. Do the little things that will actually be precursors to the outcomes that you want, which is deals and money or partners.
All right. I love it. So you're saying, I don't like the phrase slow and steady wins the race, but that is kind of what you're saying. You're just being consistent.
Move forward at whatever speed, even if it's slow.
Yeah.
Move fast. I love fast, but if you can't go fast, do a little.
I always looked at the hare and the tortoise story, and I thought, well, why can't you just be a fast rabbit and keep going? I never thought slow and steady wins the race. That's dumb. I mean, that's what the 7-year-old Brian said when he first heard the story. I'm like, I'd rather be the rabbit and just keep running. But
it took me 13 years to be in the seat where I'm at today, right?
Yeah.
It took me a long time of doing little things while I had an entire 4 kids and a whole career and grad school and everything else, right? It was just little bits at a time.
All right. Hey, well, thanks so much for coming today.
Brian.
Really appreciate your time, and especially for doing this on relatively short notice. So appreciate it, man.
Of course.
All right. Now we're going to do virtual networking. We've got 20 in the room right now, which makes for pretty good networking. Before we go into the virtual networking, something I like to do is what I call shameless plugs. Who's got a shameless plug, a need or a want that they want to present before the group? And incidentally, Drew just dropped his email address in the chat box for anybody who wants to contact him later. So shameless plugs, who's got one?
Sure, I'll go, Brian.
There we go. Boom.
Hey, if there's anybody in the DC area, like Northern Virginia, I've been hosting just a local meetup. And this month we're doing it virtually. So if you're moving to this area, that's Maryland, DC, and Northern Virginia, hit me up. I'll gladly invite you. It'll be a Saturday for an hour. Just grab a cup of coffee and get to know some local folks. That way you have a network when you arrive.
All right. And I am a plank holder. Was December your first one? I was at the December one.
December was the first one.
All right. So go to her meetup. If you're in the DMV area, definitely go to those. Sorry I missed last month's. I had COVID. I really did. But whoops. All right. Who else has shameless plugs?
Hi
All right.
everyone. This is I'm sorry.
Oh, go ahead, Julia. Go. Yeah.
Okay, so my boyfriend and I were looking for deals in Guam. So if you know anyone, especially if they're in the military, that'd be awesome. So if you know anyone in Guam, if you can put us in touch, we'd really appreciate that.
All right. Sounds good.
You know
All right.
Rory Compton? Sorry, Brian.
Do you guys have a shameless plug?
No, I was just gonna mention Rory Compton to get it. So
Oh, is Rory in Guam now?
he is in Guam, yeah.
No, I didn't know that. Okay. All right. Cool. All right. So here's what we're going to do then. Actually, I got a shameless plug. Why not? Right. So Diary of an Apartment Investor podcast is awesome. I'm always looking for guests. My pool of, if you guys haven't heard the podcast before, I bring an experienced investor on and an aspiring investor on at the same time. There's actually a lot of people in this group that have been on, but my pool of aspiring investors has started to shrink to the point to where it's hard to put the show together. So if you guys want to come on the podcast, if you're one of those guys that put a 0 in the box earlier, let me know and, send me an email. I'll drop my email in here as well. You guys should all have it already, but I'll drop my email in here as well. And trust me, if you want to come on, you will be able to come on. So, all right. All right. And that said, we are going to move on to the, I can't type my email address and talk at the same time. All right. That said, we're going to move on to the networking phase. What we're going to do is just open up some breakout rooms. And, right now we're at 15. I like to keep about 4 people per room. And I know people are going to drop. So I'm going to open up 3 rooms right now and we'll see if that works. Set a timer for 12 minutes and here we go.
There you go. Now you're not frozen. Good to see you.
All right, good.